Well, hello everyone. Hello, Raphael. And thank you for joining us on our every 2 week live stream. And Elaine, good to see you as well. Thank you for joining us. And Jenny, nice to see you again. Martin, hello. Inexis Chris, hello. Johnny123, hello. And so we'll do the usual thing, which is if you want to super chat, you'll go to the top of the queue in terms of the questions. And I'll just start off by giving a little bit of a background for what's been happening in markets over the last 2 weeks. I think it's interesting that we've had the stabilization of the sell-off, but we still haven't really seen things bounce back to where they were, which is kind of healthy because I think markets were hugely overstretched. So many of the people that were, expecting things to just bounce back as they have done in the recent weeks and the recent months, they didn't see it. And I think we just have to expect low returns when we get valuations like this. So for me, it wasn't really a surprise, but I think for some people who've only been involved in markets when things were just going exponentially upwards, it was a bit of a shock. But remember, markets can go down as well as up, and they can go down for a long time. So just be aware that that could happen, and justify or at least kind of manage your expectations about what returns to get with equity. So so let's start off by going through some of these questions, and we'll just take it from there. And I should say, of course, that this is just one way in which you can interact with us. If you want something more one-to-one, you can have a power hour with me. And if you go to our website, pensioncraft.com/power hour, there'll be a link to our description to that power hour. And you can join our community. It's $10 a month. I've tried very hard to keep the price low so that anyone can join. And, you can leave at any time. We'd rather you didn't, but you can. And you get Slack access, so you get access to the chat application Slack, so you can speak to me or other members of the community. And increasingly, what I'm finding is that other members of the community answer the questions as well as, if not better, than I would. So it's a very useful resource having the other people who are of a like mind, because of course, I tend to attract people who are similar to myself, who have a long-term mindset, who aren't just in it as a trader, but they're in it as an investor and who like to control their risk. But we also have some people who do trade alternative assets too. So it's a fairly wide range of experience, but very useful as a community, and very helpful, I have to say. So let's get started on the questions. That's enough of my terrible sales job for now. Right, so hello to everyone if I haven't already said hello. And Scott Munning says it's rainy in the northeast. I'm sorry to hear that. It's rained here in Amersham as well. So Bran says, hi everyone, a stock is overvalued if it has a very high PE ratio. What's the equivalent data to look for in order to know if a government long duration bond fund is overvalued? Now, that's a really interesting question. For example, I knew an equity a quantitative analyst, who just looked at yields. And if yields were, lower than usual for US Treasury, say, that was a sign that they were expensive. So it really can be as simple as that. So let me just show you what I mean, actually, because we can look at long-term series from Fred. And let me just change that, and I'll do camera and picture. And we'll look at Fred. And what we'll look at is a 10-year constant maturity, 10-year treasury. And we'll just look at the time series. So let's look at, now you can look at the 20-year, the 30-year time series. This is a 10-year. And we'll look at as much history as we can get. So you can see that since 1960-ish, 1962, the 10-year rate has never been lower. So currently it's at 0.68%. It peaked at 15.84% during that Volcker period in the early 1980s. And in 1965, which is the last time it was even remotely as low as it is now, it was only, it only got down to 4%. So currently, super low levels. Now, there's a difference between saying, is a bond fairly priced and is it cheap? So really, all you can say with a bond, it's almost always very close to fair price. It's very unusual for a bond to be even a few fractions of a percent away from its fair value. But what you can say is the income is low. So if the US Treasury were to issue a bond today, a 10-year bond, it would only get about 0.7% as the coupon of that bond. So what you can say is that the incomes are low. So the question is, how does that affect the bond return? Is that going to mean a low upside for bonds? And what does it mean for the downside for bonds as well? And in fact, that was one of the questions which is only available to members of the community, which for $10 you can join, where I talked about the potential upside for bonds, because a lot of the community has been asking the same thing. And what I would say is, don't forget why you buy treasuries. You don't buy treasuries to get rich. You buy treasuries as a hedge for equity. You also buy treasuries for a small, safe income, and that particular use is no longer as useful because the income is so low. And it's actually negative in real terms because inflation is higher than the income you get with the treasury. And the kind of third reason is as an equity hedge, because if equities fall, treasuries gain in value. And the longer the duration, the better the equity hedge it is. So, the equity hedge is still there. The small safe income is kind of there, but it's very small. And, it still preserves your capital in the sense that it's issued by the US government. So the credit risk is almost zero. And it's extremely liquid. It's very hard to find an alternative to treasuries. So there's a lot of people talking about the end of the 60-40 portfolio where you have 60% equity, 40% bonds. But what's the alternative? There is no liquid, safe alternative for treasuries or other developed market government bonds. So I think, it's really hard to replace bonds in a portfolio. And practically, I don't think it's true that, treasuries no longer have a place in people's portfolios. I think for many people they do. To reduce the level of risk and to hedge your equity holdings. Okay, so that was my...
Like and share.
Oh yes, please like our channel and this stream. And please do share it via social media, because then other people will know that we're live right now. I see we currently have 58 likes and 171 concurrent viewers. Normally it's good if we have like half of the people liking it. So if we could get, say, 80 likes, that would be wonderful. So please do like it, and that helps us a lot. So I hope that answered your question, and we'll move on to the next one after Bran. Hello, Jonathan Bull. Hello, Mr. Patrickakis. Hello, Harrod Property. So Multiform says, hello, I'm 28, invested in Vanguard stocks and shares ISA and SIP. Me too. It's likely that in a few years I'll move back to my home country in Europe. How do I hedge against sterling volatility while invested in Vanguard funds? So at the moment you live in the UK, I assume, and you're going to move back to Europe later on. Now, if you're in the UK, then you don't have any risk, any currency risk from sterling investments if they're in sterling assets. So if it's UK government bonds, UK investment grade corporate bonds, or UK equity, none of those carry any currency risk at all. But the minute you put money into foreign assets, so that's foreign shares, foreign bonds, or commodities which are priced in dollars, you immediately have a currency risk. So how do you protect against that? Well, you can buy hedged funds. So if you look at one of these funds which is hedged, let's have a look. So let's have a look at the Vanguard site and I'll show you what I mean. And I'm going to show you camera, picture in picture. Okay. And let's look at Vanguard's website. And so let's go to Vanguard. And what we're going to look at first of all is their list of UK funds. But we're going to look at the full list to start with, and then we'll just restrict it to the fixed income ones. So those are the bond funds. So I'll take away the blended, I'll take away the equity, and we'll just look at the fixed income. So these are the bond funds. So this one, Euro Corporate Bond ETF. So that one doesn't look like it's got a hedge. And in fact, I think Vanguard is really unclear about whether it's a hedged fund or not, unless it's one of the life strategy funds, in which case it lists them and it tells you whether they're hedged or not. So let me show you what I mean. So if we look at the portfolio data for Life Strategy 20, you can see that the first fund here is Vanguard Global Bond Index Fund, and it's sterling hedged. So you can immediately see that that one is sterling hedged. And this one's Developed World Equity, and it's in sterling, but it's not hedged. So you will be taking currency risk there. This one is UK government bonds, which is in sterling, US investment grade credit, sterling hedged. And what you'll notice if you go through this list, all the ones which are hedged are fixed income funds, in other words, bond funds. So if you do want to protect yourself against sterling versus US dollar or euro, then you'd go for one of these hedged funds, because that reduces your currency exposure to almost zero. So whatever returns you'd get in dollars, you'd get in pounds. That's the way the hedge works. It won't be perfect, but it'll be pretty damn close if they do their job properly, which, let's face it, Vanguard is going to do. So that's the way you get a reduction of your volatility, because you're not taking the currency risk. And it's easiest to get it for bond funds. You very seldom find equity funds which are currency hedged. So if you do want to get a currency hedge for equity funds, that's much harder. There are very few funds which actually do that. So if it's equity, you'll have a hard time, unless it's Japan or South Korea, in which case there are often hedges, because their stock market performance is counteracted by the foreign exchange movements. So for them, it does make sense to hedge equity, but most of the time it's not worth it, because equity is so volatile, much more so than currency. So I hope that answers your question, Multiform. Yeah, so that's how you'd hedge. Gary says, if interest rates in the UK went negative, what would the effect be on markets? Right, well, I think it depends on the reason why rates went negative. So at the moment, the Bank of England is kind of hinting that it might be thinking about negative rates. In terms of things like mortgages, unfortunately, it doesn't mean they'll pay us to get a mortgage, because you'll still have to pay fees, and when you add those, it'll still end up being positive. It does mean that you'll get low rates, because if negative rates are what the banks are paying, then they're going to pass that on to some extent to us. But if you do have a very large cash deposit, some banks may actually charge you to hold your money. UBS, for example, was doing that with some of its very large deposits. But it'll take a lot of banks to do that in order for it to become acceptable. So it'll be very difficult for the first bank to say, we're going to charge you for your deposits. So that's one effect. Generally, if the interest rates are going negative, the reason for it would be that something really bad is happening in the economy. In other words, the central bank is desperate to try and stay, kind of shore up the economy. And if that's the case, then it's going to be a bad story for equity. A bad story for the economy is usually a bad story for the equity market. So I think the reason for the negative rates is the key thing. The negative rates are just a side effect. They're not the cause of the problem. The problem is what's driving the rates to be negative. So I think that's the most important thing. Why are rates negative? And if it is because the economy is very weak, which frankly it is in the UK, we're talking now about a second wave of lockdowns. We're talking about the repercussions of Brexit. We could be paying ridiculously high tariffs for some imports from Europe if we go to World Trade Organization tariffs, and companies won't be able to have frictionless trade unless we agree these deals properly. So that could have a drag effect on the UK economy for some time to come until there's some kind of resolution of those tariffs with the trade deals. So, there are a whole bunch of reasons why, we've got a weak economy. And so that's what really matters, is what's the cause of the negative rates, and, how long is that going to last? So if rates do go negative, then that's the yield curve moving down. If yields move down, bonds go up. And so that would be a positive for the UK bond market, for example. It would usually be a negative for the equity market, because if the economy's in bad shape, that means corporate earnings weaken and equities tend to suffer. So bad for the equity market, probably. And usually it's good for the bond market, because the bond market tends to react in the opposite way. Bad economic news is good news for the bond market, unless that bad news is inflation, in which case it is bad for the bond market. But generally, bad economic news, good for the bond market, the government bond market, and bad for equity. So that's probably the main effects. And no, your mortgage won't be free, unfortunately. I hope that answered your question. Right. So the next question is from Chris Green. Hey Ramin, given the recent sell-off in tech stocks, do you expect there to be a rebound soon, or to maintain current levels for a while? Well, I really wouldn't change my allocation based on what happens in markets alone. What I'm saying is, if you bought tech stocks at a higher price, surely you'd like to buy more tech stocks at the new lower price. So the reason for buying the tech stocks probably hasn't changed, because valuations haven't changed much. They're not a lot cheaper than they were. So personally, I never do short-term trading, because I know with almost certainty that I'd lose money that way. What I can do is to invest over a long period of time, and because there won't be much trading costs, because I won't have lots of cognitive biases which would break my returns, that tends to work very well for me and for most people. So personally, I wouldn't do anything tactical. I wouldn't do anything different to what I did before. If you had Amazon stock before, maybe buy more. If you still think the reason why you bought Amazon is in place. But if the reason why you buy Amazon is because it's gone up or down this week, you will almost certainly lose money. So, do I expect it to rebound? I have no idea. Over a even 5-year period, it's very difficult to call which way markets are going to move. Even equity markets as a whole, and single stocks even less. What I can say is that over very long periods of time, equity markets drift upwards. And you can almost certainly make money over decades if you get exposure to that drift. If all you see is the volatility, you'll end up like a kid on the football pitch, which is just chasing the ball. If you watch little kids playing football, they just chase the ball around. If it goes this way, all the kids run to one side of the pitch. If it goes the other way, all the kids run to the other side of the pitch. If you watch professional footballers, they pass the ball between themselves, they get in position to score. you don't just chase returns. You have a view and you stick with it for very long periods of time. That's the way you make money, not from chasing returns. So to answer your question, Chris, I have no idea. Personally, I think that the reason why tech stocks has rallied is because they've generated really good profits over the last decade. Will they continue doing that? Almost certainly. You know, we haven't stopped using Google, Netflix, Amazon, Apple, and in fact, we're probably doing more of that than we did in the past, pre-pandemic. So, you know, I think the thesis for that is still in place. And, you know, I'm quite bullish on tech long term. Maybe the valuations were overstretched, but if you're investing for the next 30 years, hey, you know, you'd still keep your exposure. Alain says he liked the stream already. Thank you, Alain. And thank you for your kind comments 2 weeks ago. We still remember that, and that's very kind of you. The other Mike says, hello, Ramin, just like the noodles. In fact, it's Ramin, Ramin. But I do like ramen noodles, as it happens. And American people pronounce my name like the noodles. They say, hi, Ramin. Hi, Ramin. I lived in California for a long time, so I always used to say, like the noodles. Okay, so hello, the other Mike. Martin Mendez says, hello. Which bond ETFs do you think are good as safe havens for long-term holding and hedge? TLT or IEF? I'm concerned by the very low interest rate. So let me just, for those who don't know, the three funds in America which are issued by iShares, which have the extremes of duration, are SHY, which is 1 to 3 year treasuries, IEF, which is 7 to 10 year treasuries, and TLT, which is 20 years plus. Okay, and if you plot the returns for those three, SHY is just like cash. It just doesn't do anything. Its value is just roughly constant forever. You know, the equity market sells off, you know, equity markets rally, and it just keeps the same value. IEF is much more volatile. So if equity markets fall, it rises. If equity markets rise, it falls. And that's because it's got longer duration. You've fixed in a fixed rate of interest for a long period of time, more than 5 years, roughly 6 years. And that means that if rates go up, the price will go down. And if rates go down, the price will go up. And it's quite sensitive to that. TLT is the same as IEF, but even more so. So if equity markets fall, that thing rises a lot. And if equity markets rise, it falls a lot. And it's also much more sensitive to yield curve movements. So a fall in the yield curve means a massive rise in TLT, and a rise in the yield curve means a massive fall in TLT. So if you are concerned that interest rates are going to increase or inflation is going to increase, then you'd go for the shortest duration fund, which is SHY. If you think interest rates are going to fall or inflation's going to fall, you'd go for the longest duration, which is TLT. Just like if you're on a sailing boat, if you think there's a really big storm coming, then you kind of furl the sail. So if you think interest rates are going to rise, you furl the duration sail, you go for short duration. If you think interest rates are going to fall, you open up to a full sail because you want to get the full effect of that rise in the price of your funds, pushing your portfolio value. So that's the way to think of it. You've got to think about duration as a way of monetizing yield curve movements. So that's probably the way to think about it. So to answer your question, if it's TLT or IEF, you know, it really depends on which way you think yields are going to go. Okay, next question. Oh, here we go. So, given the increasing shift of economic power to Asia, and most global index funds are weighted towards the US, do you think buying Asian-denominated index funds is a better investment strategy? Well, yes, but I'd be slightly concerned about. Okay, so firstly, there are two flavors of Asia. There's developed and emerging. Emerging is primarily China. It's about half of emerging markets and probably more of emerging Asia. So that's really what we're talking about. If we're talking about Asia, which is emerging, it's China. Do I like an allocation to China? Personally, yeah, I do. I do like China. I'm quite bullish about China's ability to grow its earnings and to outperform the US over the long term. But it is much more risky. It's much more volatile than the US. Politically, I used to say that the US was more stable than China. Now I'm not so sure. I think, if we do get a situation in the US where the president refuses to leave office if he loses the election, you have to question whether that's a politically stable country, and it may cause serious problems. So, China now looks relatively safer, I'd say, politically, than it did, say, 5 years ago. So, yeah, I'd be concerned about the political arguments in the US at the moment. But the US, whatever has happened in the past, the US has just been incredibly good at growing their earnings since the Second World War. They've done it better than everyone else. So I think that's why I still think the US is a good bet for the next 10, 20 years. But if I did want to have a long-term allocation, so say you were creating a portfolio for your children who will be investing for the next 50, 70 years, for them an emerging market allocation certainly makes sense, because over their lifetime, whatever volatility there is basically irrelevant. What matters is growth. And the greatest growth is going to be where economic growth is greatest, and that's going to be in emerging markets. So yeah, I think a tilt towards Asia, if you have a long-term view, makes sense. A tilt towards emerging markets makes sense. Maybe not take huge risk, but certainly keep some in the US. Diversify certainly, and maybe have a satellite investment in these smaller markets, or at least emerging markets. So Zishan Rahman says hi. Hi Zishan, nice to see you again. Okay. Yes, so do like our channel. I see we've got 245 concurrent viewers now and 135 likes. So it'd be great if you did like our channel. Remember, you can always arrange a power hour with me if you want to have a one-to-one like this. And there'll be a link in the description below to see how to do that. And you can join us in our membership for $10 a month and support what we do, because, we have to eat. And that reminds me of my dog, because he has to eat as well. And he's asleep under the desk. So Teddy, do you want to just demonstrate eating for the people on YouTube? Come on, Ted. Ted, you can eat. Ted, jump. Oh, yes, he rests on me.
Can't see it.
Oh, no, you can't see Ted. And again, over here, Ted.
Yay.
Hey, Ted.
Oh yeah, I can now.
Up, 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 up. Come on, up. Oh, good boy. Oh, he's so good. He's a YouTube star. So that was my dog Teddy. And both he and I have to eat. So if you could support us on Patreon, that would be great. So, next question. And remember, you can do a super chat if you want to go to the top of the queue. Otherwise, I'll just work through the list of questions. And hello. Marek says, hello. What do you think about Vanguard 60%? Is it still worthwhile to invest? Well, if it was worthwhile 5 years ago, it's still worthwhile now. If you want 60% equity allocation in your portfolio, if that's suitable for you, if that kind of level of risk is good for you, then yeah, I mean, it's a pretty good investment. There are other multi-asset funds out there. HSBC has a list of global funds, 5 of them, just like Vanguard's Life Strategy, which are cheaper. I think they're 0.17%. They don't have a UK bias, which UK Life Strategy does. And there's also the MyMap funds, which are actively managed from BlackRock. So there are many alternatives which are actually a bit cheaper than LifeStrategy, but LifeStrategy is pretty good. It does the job. It does have a UK bias, which I don't like, but it's well diversified. It's done fairly well. No surprises in terms of returns. The higher risk one has given you the best returns. The lowest risk one's given you the worst returns. And in the sell-offs, the low-risk one sold off less. It behaves exactly as you'd expect it to. So LifeStrategy 60, yeah. If you liked it before, you should like it now. As I say, I don't think the LifeStrategy 60... I don't think the 60/40 fund is dead, which is what LifeStrategy 60 is. David Garr says, good evening, everyone. Good evening, David. Alain says, does anyone know platforms in the UK where investors can trade options in order to benefit from their holdings, such as selling covered calls? Not as an ISA or SIP, but a regular trading account. In America, it's much easier to trade options. In the UK, you can find warrants on some of the websites, on some of the platforms. I can't, off the top of my head, think of one of them. But if you look for warrants, you'll see, those are available on some of the platforms. But yeah, much harder in the UK because, retail investors in the UK always have to put up with a smaller market and less people invest in the UK than they do in the US. But with things like Robinhood, if it had come to the UK, maybe they would have made that available. But, I think for most people, options are probably too complicated because I think very few people understand them. I struggle with some of the concepts with options, but I used to teach at an investment bank on, our sales and trading staff about options. So I know quite a lot about them, but I think for most people, it's probably best that they don't try and they do just buy ETFs. But to answer your question, Alain, no, I'm not aware of a UK platform that does that. Robinhood, in fact, Alain says Robinhood in the US is simple and good, but I don't know any platform in the UK, neither do I, unfortunately. There are things like contracts for difference, but those are fairly toxic and they are just gambling products. So I really would keep away from that. But yeah, I don't even like platforms that sell CFDs, which gets me some flack, but I stick by that. Okay. Chess Dad. I remember you from previous calls. I noticed there are a few countries with government bonds at 3% yield or above, like China, for example. Any comments on this? Yeah. And the thing is, if there's a credit risk from the issuer, which there is for emerging markets, then typically you find a higher yield. Now, China is 3% because China is practically a developed market in many ways. It's emerging in some, it's developed in others, but certainly in terms of the yield, it's not super high. Other countries in emerging markets would give you a much higher yield. So countries like Mexico, perhaps, or Brazil, or other countries which are more likely to default, so perhaps Russia. Those countries have to pay you a higher coupon because they have a recent history of defaults. So that's why they'll pay you more, because there's a higher risk. So as always in investment, you don't get a free lunch. If there's a higher return, you bet there's a higher risk. So that's why emerging market sovereigns like the Mexican government, Russian, China, Brazil, those will give you a higher coupon. But just be aware that there's a higher risk. Another thing to consider is whether you buy the local currency version of those bonds or the hard currency, dollars. So what you could do, so let's say you're the Brazilian government. If you issue in Brazilian reals, then, and I buy it as a UK investor, I'd be worried about the strength of the Brazilian real versus sterling. Because if the Brazilian real weakens in a crisis of some form, then that'll reduce the value of my fund. If Brazil chose to issue in US dollars, which they can, a hard currency fund, then I wouldn't worry so much about a devaluation of the Brazilian real because those bonds are still issued in dollars. So all that matters is the value of the dollar versus sterling, which is still a risk, but it's less of a risk because emerging market currencies tend to have higher volatility. So hard currency is a bit safer than local currency, but it also usually pays a slightly lower income as a result. So those are the kind of trade-offs that you probably should be thinking about. And for any fund, you can always look at the breakdown of the ratings, whether that's a country and a sovereign rating or a corporate bond rating. So you can always do that. So time to drink my branded drink now. And to remind you, please like our stream. And I see we have 300 people now and 153 likes, about half of you liking what you're seeing. Well, please do like, it helps us a lot. And don't forget, you can support us by paying $10 a month and join our community online. And, you know, we have these sessions for a much smaller group of people on Sunday evenings, every other Sunday. So those are much more intimate, I think, and you're much more likely to have your question answered because there are less of us. Okay. Somebody says Amersham is beautiful. I absolutely agree. Amersham is beautiful. That's where I live, in case you don't know. In fact, I was just walking in the woods today with Teddy thinking exactly the same thing. What have I done to deserve such beautiful woods? It is gorgeous here. Felipe Valen says, are leveraged ETFs like TQQQ good for a long-term hold? Now that is an interesting question because I recently came across, well, not that recent actually, I came across something on the Bogleheads forum where somebody had a 60-40 portfolio, but it was 60% of a levered S&P 500 fund and 40% of a levered treasury fund. So it was a 60-40 portfolio, but both of the components were, I think it was triple levered. So since I saw that, I've been tracking the performance of various portfolios, which are combinations of those two, just to see how well they're doing. And what you can see is that when there's an equity market sell-off, the sell-off in the 3 times levered fund is dramatic. I mean, it's huge. But over the long term, you naturally would expect, if equity markets drift upwards, that the levered fund would outperform the unlevered version. But it comes with a huge risk. So if you're the kind of person who'd even think about selling if things go down in value, this is definitely not for you. But if you do have a diversified levered portfolio, it actually does fairly well. Not as well as you might think, but it still does pretty well. The reason why it doesn't do as well as you might think is because let's say you get a 50% fall. In order to get back to where you were previously, so if you go from 100 down to 50, a 50% rise won't get you there. You have to have a 100% rise to get back from that 50% fall. So there's an asymmetry in the returns of a downside and an upside move as a percentage, just the way the maths works. And consequently, because the levered funds match daily returns, they can't match long-term returns. So if over a year the S&P goes up 10%, the levered fund won't necessarily go up, 20% if it's 2 times levered, because it depends on the path that the S&P took. And during a volatile period, these levered funds leak returns. So that's the danger. You get kind of sideways movement with leverage, in which case you get a leakage of value from levered funds. So, there are periods when it has done very well, and this equity market sell-off has really knocked these levered funds badly. But yeah, I mean, it's kind of interesting. But again, for most people, you want to keep away from leverage. Just buy a cheap fund which tracks and global markets. Diversify, keep your fees low, and stay away from leverage and options, because for most people, it's really not necessary. Okay, next question. How are we doing for time? We've got 20 minutes, 19 minutes. I'm going to finish at 8 o'clock UK time. And the question is, what platforms can UK investors use to invest in American ETFs? You certainly can do that. You can get some American ETFs with platforms like I know that if Robinhood had launched in the UK, you could. Yes, I think there is a UK platform. In fact, I've reviewed it and my mind's gone completely blank. I've forgotten the name of the fund. I've forgotten the name of the platform. And see if I can remember. No, can't remember between us, I'm afraid. So, but there are UK platforms where you can buy US ETFs. And yeah, I can't remember what they are. Sorry about that. But they do exist, and for the platform I'm thinking of, they actually ask their customers which funds that they want added. They listen to what they say and they add them. Incredible. And it's called Free Trade. Free Trade is the company I'm thinking of. So I've done a review of them, and it's app based. It doesn't have a web interface yet, and that allows you to do that. But I would question why you want to do that. I mean, America tends to have a much bigger selection of ETFs, more kind of esoteric things. So if you do want to get these kind of leveraged ETFs and other slightly more unusual ETFs, you can do that in the US. But for most people, again, it's probably not worth it. You can get very wide exposure to markets here in the UK. There are thousands of ETFs already available. If you want single country stuff, you can get it. Particular pockets of the fixed income universe, you can get it. Maybe the fees would be lower in the US. That would be a good reason. But yeah, sometimes you just got to question whether you really need it. But it would be nice, to get a bigger choice. But for most of the stuff I have, I go for fairly vanilla things. Global equity, US treasuries, UK gilts. There's not much more I really want, to be honest. Maybe gold would have been nice. With Vanguard, I can't even get that. So, that would be good. But, if Vanguard was like it was in the US, we'd have access to hundreds of ETFs which weren't from Vanguard. That's what they offer in the US, but they don't give it in the UK. And they've got a much wider range of Vanguard funds. So it would be great to have that. Vanguard, if you're listening. Okay. Next question. Hi, Ramin. Thanks for the great content. My pleasure, Leo. Can a single global bond index fund fulfill the bond needs of a portfolio? Thinking of VG, global aggregate bond fund, to keep things simple. Yeah, in fact, I created a video called How to Build a Two-Fund Portfolio, where I talk about exactly that, and I talk about the global aggregate bond index, of which there are many trackers. Because remember, it is an index. It used to be it was created by Lehman. It used to be called the Lehman Aggregate Index. Then Lehman sadly passed away, and now we've got Barclays Bloomberg Aggregate Index is what it's called. And there are lots of funds which track it. And yeah, it gives you global bond exposure dominated by the US because they have a bigger market. And yeah, it gives you the negative correlation with equity. It gives you global diversification, which allows you now to build a two-fund portfolio, which gives you globally diversified exposure, which you just couldn't have done even 20 years ago. Now you can do that fairly easily and very cheaply with just two funds. So yeah, you can do that with two funds now, and Barclays Ag is a good way to do it. Right. Oh, interesting. Next question. And could you please do a video on what a safe withdrawal rate for someone wanting to retire might be? So if you look at my video on, I mean, you may not know it from the title, but if you look at my video on the golden butterfly versus the pinwheel portfolio, which I did 2 weeks ago, last week, that's in there. So I talk about safe withdrawal rates in that, and also how to use the portfoliocharts.com website for a particular portfolio to see what the safe withdrawal rate could potentially be. Now, as with all these things, you have to make assumptions. So just to explain what a safe withdrawal rate is, let's say that you had some asset that was guaranteed to give you a 5% return forever, okay, to keep it simple. Well, in that case, you could make a 5% withdrawal from that fund every year forever, and you'd have a constant income forever without reducing the amount of your capital. Now, of course, you never know. There's no single asset which can do that. All you can do is look back in history and say, for this portfolio or for this asset, this fund, what level of withdrawals either kept the amount of capital the same or ensured that my money wouldn't run out over a 30-year period. Now, if the asset returns, so let's say the safe withdrawal rate for some portfolio, golden butterfly, whatever, is 6%. What that means is, historically, over a 30-year period, you have to give the period, at no point did that money run out over the 30-year retirement period if you withdrew 6% every year. Now, inflation might go crazy in the future, in which case that wouldn't be true. And remember, when you withdraw money, when it says a 5% withdrawal rate or a 6% withdrawal rate, that's just for the first year. Every year after that, you have to increase the expenditure by the rate of inflation. So, it might be 5% to start, but if inflation goes crazy, like it did in the 70s, early 80s, then the amount you withdraw will have to increase a lot more than 5%. So it has to. That's one of the things you have to consider in the calculation, and that's what portfoliocharts.com does. So if you haven't played around with that, I strongly recommend you do that, because it's got a great way of, the best way to learn these things is to actually try it out. And the back tests are a good way to figure out what the safe withdrawal rate is for a given portfolio. But remember, all these things are backward looking. So what you're assuming is that the future kind of resembles the past, and it gives the worst case portfolio. So, what's the percentage that wouldn't have run out of money in the worst case for any 30-year period since 1970, for example? So yeah, I think safe withdrawal rates are a great concept, because when you're planning your retirement, that's what you want to know. How much of my money can I take out and still not outlive my money? That's the key thing. Okay, that was from Person X. Thank you for your question. And Alain is just kind of amplifying what we said about hard currency and local currency. And Julian says, good evening. Do you believe in the outperformance of small cap value? And when will ETFs of this type be available outside the US? In the Netherlands, only ZPRV and ZPRX are available, but very low assets under management. So I'm guessing the Netherlands is kind of like the UK. Very little choice compared to the US. So small cap value. So if you plot small cap value versus small cap growth over the last decade, you can probably guess that value has hugely underperformed. And it's interesting if you look further back, because I was just talking about portfoliocharts.com. The data for portfoliocharts.com comes from the Simba spreadsheet, which is published by the Bogleheads Forum. You can download the Simba spreadsheet and do your own back tests, which I did. And when I created a portfolio using data since I think 1930, by far the best performing portfolio, both in terms of drawdown, in terms of sustainable withdrawal rate, was always hugely dominated by value. Now, since 2009, value's been completely destroyed relative to growth. And that's true of small cap, mid cap, and large cap. So all the stuff that which worked in the past is now completely failing to work. Over the last, it's not just a few years, it's since 2009, it's 11 years. So do I think small cap value is going to recover? Well, in order for that to happen, what would have to happen is interest rates would have to be more normal. In other words, when interest rates are very low, it favors growth over value. So if rates were to normalize, then yeah, I think value could outperform. But at the moment, we're not going to see normal interest rates for some time to come. The Fed, in its latest meeting, said they expect it to happen, at least if you look at the dot plots, at around 2023. So we could be talking, 3 more years of misery for value investors. And it's like a kind of standing joke on financial Twitter. People always joke about people being bruised. So they show a picture of a bruised person saying, I'm a value investor, right? Because, they've really suffered, these people. So yeah, I personally, I think it'll take a while before value can recover. And it's tech again, right? Tech is simply doing better and it's growth. So that factor simply is trouncing value. So personally, no, I wouldn't go for small cap value, even though historically it's done incredibly well. With this new normal that we find ourselves in with low interest rates, it's not going to do well anytime soon. Okay, so that leaves us with 7 minutes. Okay, so please do like. So we've got 188 likes, but 300 viewers. So please do like. That would be great. It helps us a lot. And consider joining us on Patreon for $10. We offer that for very little, and we think we give a lot. So we think you'll get a lot out of the community if you want to learn about investing. Not trading, but investing. Okay. Next question. What's your opinion on Hypnosis Songs Fund? I've no idea what that is. I'm sorry. Is it even worth investing in bonds? Yes, because as I say, the 3 reasons why you'd invest in bonds: diversifying equity still works, capital preservation still works, income not so much. But 2 of the 3 reasons for owning bonds are still there. Government bonds, that is. And other bonds offer you pretty good returns now, right? So emerging market local currency bonds, 5-ish%, high yield, 5-ish% in terms of income. So, it really depends on the type of bond as well. Okay. How long have we got? 5 minutes. Next question. Hi, Ramin. With my AJ Bell stocks and shares ISA, with both US sell-offs this year, the equity drop coincided with a dollar strengthening, which offsets price drop in pound terms. A way around this? Yeah, I mean, you could, in theory, find a currency hedged US equity fund, but they're pretty hard to find. I think they do exist, because then the returns that you see will be the dollar returns. So, when the equity drop happens, then it's actually not going to help you in the case of the fall, because so let's just talk through what happens. So when equities fall in the US, then the dollar will strengthen, and that partially counteracts the fall in equity. So it actually helps you, the fact that the dollar strengthens. if equity markets then recover, that's when it hurts, because then the US dollar will sell off, and it'll counteract the rise in US equity. So really all this is going to do is kind of iron out the kinks, so it'll just make it less volatile. But yeah, I mean, that's one way to do it. If you don't like the volatility due to FX, you just buy a currency hedged US fund. Okay, and then Alain says, do you think buying options is hedging and selling, especially put options, is a bit more risky? What do you think? Also, common small investor cannot trade currency swaps, true, or credit default swaps. Only hedging can be done is options such as covered calls or married puts and collars. Am I right? Yeah, you can buy, I mean, in the US, certainly you can get buy right indices or covered call indices, there's a whole bunch of stuff available, funds which do this for you. Okay, look, what I do like about options, and I love teaching about options, and I love options, so I really miss talking about them. But what I do like about them is you're absolutely clear about your maximum loss, which is your 100%, which is actually pretty likely with an option, but the amount you put up is fairly small. So the maximum loss is very clear. The maximum upside is also usually very clear. So in terms of risk management, it's great. You know exactly what you're going to get. You know the investment horizon because it's built into the options. You know pretty much everything about the trade. So you can be very tightly controlled in terms of your risk and your reward, which I think is great. But as I say, I think for most people, they're not going to understand, what a call spread is, or the kind of importance of volatility, or the Greeks, So for most people, I think it's just too complicated. And like you say, for retail investors, you can't buy things like CDS if you want to have a pure credit view, or interest rate swaps or currency swaps if you want to lay off some of your interest rate risk or your currency risk. But all you can do is buy prepackaged, products which have some equity in them and some options, or they sell options in order to enhance yield. So you can always do that. But yeah, I think that's just a way, they're trying to protect retail investors, the regulators, by not allowing that to happen, which is probably a good thing. You've just got to look at what happens with Robinhood or contracts for difference, where 80% of people lose money, to see that that's a bad thing. But anyway, we're just coming up to 8 o'clock, which is probably a good place to finish. Thank you all so much for your time and your brilliant questions. Always good. And thank you for watching Teddy do his trick. And we'll see you again in 2 weeks' time. It's still not too late to like this, so please do like this stream. Join our community. It's just $10 a month. And if you want a power hour with me, one-to-one, just go to our website, PensionCraft.com, and power hour. There'll be a link in the description below. And thank you for listening, as always.